Well, every single one of you probably have a different reason for coming and watching my shows on a regular basis. But just in case you don't know why I do my shows and what I'm hoping to accomplish in terms of bringing along news and information to you is that I believe that a good somebody who's investing in unique stocks as opposed to the indices or into bonds. If you're a stock picker, even if you're all in, even if you're heavily in to one stock, I mean, whether you're trading or whether you're holding long term, your decision making process with regard to all of that and how you look at how it's doing in the interim, especially a stock like Tesla that's so wild and crazy, is based on a combination of things. Number one, the fundamentals. Number two, there are, in fact, technical things that do impact stock pricing. Number three is sentiment. How is the sentiment going? What are things, what are the people thinking about the company, the CEO, of course, in this case, et cetera. And then you get into the macro of the market itself. What is the sentiment? We've just had a sentiment shift. We've gone from very risk on to slightly, at least maybe a little bit risk off at this point. And will that risk off continue? Will that sentiment continue? But there's other elements of sentiment besides risk on and risk off, but that's one of the primary drivers. But there's other things with regard to the macro also in terms of the fundamentals of the economy as well as the technicals of the overall stock market itself. And then finally, you've got the overall economy. How is the economy doing? What is it going to do in the future? How is it impacting all of the above? It will impact the stock market, of course, the individual Tesla stock. It will impact the fundamentals of Tesla, and it will impact overall sentiment with regard to the product and with regard to markets. So I hope that was well said. I hope it was understandable. Anyway, that's kind of what we're going to do today, though. We are going to be looking kind of, which I try to do every single day. I try to give you news and analysis about the company and the stock, the fundamentals, and to some extent, the technicals when I think it's appropriate, or I bring in Brian Wang in particular, or Nicholas Gibbs and well, actually, almost all of my co-hosts on the weeknights, almost all of them have some capabilities in terms of the technicals, much more than I do. So anyway, and then getting into the economy and into the stock market in general. So, and today it's a particularly rich show. It's a lot of substance. There's always substance, I hope, but I mean, I just particularly like today's show. So hopefully you'll hang in there with me as we go through these various issues today. I have lost my script, so you're going to have to bear with me while I get it here. All right, here we go. Found the script. Let's go ahead. So this is from the Jeff Lutz. You know that guy. He's on Wednesday nights usually. And he says this is a longer form post on at Tesla. This comes from at Tesla. The Model Y China launch lead times and demand. This is from Tesla, okay? There is genuine confusion and FUD. Of course, I only have the same public info that everybody else has, but I think filling it in some of the gaps on how the process works may be helpful. Judging product demand purely by website lead time in either direction is a fool's errand at launch and is highly error prone. There are several factors at play. Background on launch dates versus supply. In short, companies will typically shift or set the launch date by region and globally to the service level of the inventory supply, meaning how much product on hand is required to meet projected sell-out rate. Launching and selling out is a market gimmick or a sign of poor execution, period. Meaning launching the Model Y in China this past week and delivering the first cars predicated on having a number of days supply and inventory. That's the only way you could do it. If not hit, if you don't get it right, the company either decides to launch anyway, if they're close to, or else they shift out to match the service level. This is why we don't know these launch dates until literally the week of, or just because it's dynamic relative to pre-built inventory. because you want to have some stock before you go out there. And you don't know how good your ramp's going to go. The worst thing for a new product is to launch with low inventory and very, very long lead times. The reason is you'll lose the marketing impression benefit and interest wave as there's an insufficient supply to feed the typical very high point of interest at the very beginning of a new launch. He says, then there's confusion or FUD. Some accounts are pointing to 2 to 4 weeks lead time for the rear-wheel drive in China, and they think that means there's automatically low demand as the lead time is low. Some accounts are pointing to a 6 to 10 weeks lead time on the long-range all-wheel drive, much lower volume SKU, and they think demand must be very high. He says, but number one is a function of the new product ramp pre-build, where Tesla has reportedly been building the new Model Y in increasing capacity since November 2024. So 2 to 4 weeks lead time is not 2 to 4 weeks of Tesla's current production capacity. It's 2 weeks capacity plus all of the pre-build volume completed and net of the order book. Well, in English, he says, if we don't know new Model Y inventory on hand plus order book, which we don't, nobody outside of Tesla knows. We do not know the real demand by just looking at 2 weeks lead time. The only way to flush this out eventually are through the insurance and registration data, which will be post-fact. One can put an estimate on the pre-builds for modeling purposes, but I guarantee it'll be off by 25 to 50% or more, given all the unknowns. He says, I'd recommend, setting goalposts, but bottom line, we do not know. He says, number two, on the long-range all-wheel drive, 6 to 10 weeks, also has a pre-build component to it, but in general, this SKU would just be a scheduling issue when they'll focus on the lines on the higher volume rear-wheel drive only, because the ramp up, then there will that ramp up, and then they'll switch to build the lower volume product. We'll have to wait and see, but I wouldn't immediately read this as being a good demand. One more thing, when companies are in this mode of launch to plan future supply, what they look at are the order book daily inflow rates by region, the TAM elasticity, and the reviewer sentiment, both professional sentiment, both professional reviewers and early consumer feedback to judge medium and long-term demand. I know this leaves a lot open to questions, but one thing we do know are the reviews are very strong for the new Model Y, which is a good sign. Nothing is fundamentally broken or on the looks, the future, the price, so time will tell. He says, I hope this information was helpful. Thanks. Anyway, that is from @Tesla. Now, I don't know. It didn't sound like they're really actually part of Tesla. So who is @Tesla? Maybe I misunderstood something above. Let me know in the comments below what I misunderstood. All right. The other big news for the day with regard to Tesla are the protests at the Tesla showrooms. They do continue, but one in Manhattan Beach. I live close to Manhattan Beach. Anyway, one in Manhattan in New York City got ugly today, and some protesters were arrested after blocking the entrance and refusing to leave the premises. It's hard to know how many of these folks are paid by the Democratic Party or by others, by Soros, for instance, or how many of these folks might be prompted to protest by some kind of organized leftist effort. But for sure, these are not those that are there for honest protest are being duped by people like AOC, who continue to claim that Elon Musk has any power or desire to cut Social Security payments. She has restated as that Elon has intentions, and I've posted over and over on X. I'm reposting people over and over on X. I'm exposing them for their lie about Elon. Elon was on Joe Rogan talking about Social Security. He was talking about cutting administrivia, cutting people that are not supposed to be receiving the Social Security. In no way did he even recommend that there will be some kind of a change in any way, shape, or form as to how people get paid. But as usual, she and others No, their followers aren't going to bother to actually watch the video. They're just going to take her headline as truth. But so, with great effort, sometimes there is a price beyond money and time when you're doing something like Elon's trying to do. Elon says the death threats and the people calling him a Nazi creates anxiety. It's anxiety producing. And that totally makes sense. And I feel bad for Elon because I really believe his heart is extremely good. I believe everything that he's doing for free right now in Washington, D.C., is designed to help you and me, the overall taxpayers, help the country produce a better future for all of us. And these people are doing everything they can to keep him from getting that job done. Anyway, there is a beginning of a backlash, though, against these protests and against people like AOC who are lying full time about Elon Musk. And there are people that are saying, hey, I'm going to buy a car just to support him, or I'm going to buy the stock on Monday morning just to support him. I think that's great. I hope it gives some solace. I hope it raises the price. Anyway, I think we'll find out how it all ends in a few more weeks. I think it'll be, end of April, sometime in May, we're going to start to see how all this really ferrets out. By the way, this is Randy Kirk. You can hit the like button now if you like. You could hit the notify button. You could hit the what do we call it? Subscribe button, because the more subscribers I have, the better. It helps the channel. You could hit Patreon. You could go down below in the instructions, hit the little link there to Patreon, and send me $3 a month if you want, or 5 or 10. It's good. I could use another $50 person. Somebody out there who $50 is nothing. I don't want you to do it if it's going to be, something that, causes you to miss a meal. But for some people out there, $50 a month is like whatever, And so if you're one of those people and you like what I do here, you can support me. All right. Fortune magazine has this. Listen carefully here. You're going to notice something here. You're going to know. I know. I'm going to tell you about it. Anyway, I'm going to be intervening a lot in this article. The Atlanta Fed's GDP tracker now indicates that the economy is headed for a 1.5% contraction in the first quarter after showing 2.3% growth just days earlier. So their analysis, their understanding, all their numbers, they put all their numbers in every day, and as they see the numbers, and the numbers can shift radically. Well, this is a massive shift from showing a 2.3% growth in the first quarter. Now they're saying it's going to be a 1.5% negative. This also marks a sharp reversal from the fourth quarter when GDP expanded by 2.3%. Several economic indicators have been raising alarms as consumers and businesses brace for Trump tariffs and federal job cuts. Okay, remember now that tariffs are probably not going to have any impact, any serious impact on the economy. There's companies that are going to be impacted by it. There's companies that will be impacted for a month or a quarter, and they'll figure a way around them, or they'll figure a way to deal with them, or they'll be able to raise their prices, or they won't. It's I've done this so many times, I can't begin to tell you how many times I've had to deal with a change in tariffs, or a change in the value of money in Germany versus the United States, or China. Oh yeah, no, listen, you just have, if you're an import export, if you're doing stuff with other countries, you have to be prepared to deal with these things. And there's lots of ways to make it. But you've heard me talk about this so many times. Anyway, but the federal job cuts, I've been talking about how long now? 3 weeks, 4 weeks? I've been talking about that the federal job cuts and the cuts in the overall government spending is going to have an impact. Yeah, it's going to impact the economy. Somebody yesterday, I think I reported on this, said we'll probably be down a full point, 100 basis points, be down to 1.2 or 1.3 growth in the next quarter, in the first quarter rather. Now, one of the things is, getting the growth down that much in the first quarter is kind of hard. We're already at the end of February. Okay. And a lot of these layoffs are people that they're still going to be making money for months. And a lot of these cuts in spending by the government, it's not going to really show up until the second quarter. So having a negative number in the second quarter, I've already said over and over again, I'll repeat it again. I think we have a good chance of being flat or negative or slightly up in the second quarter. Third quarter, maybe 2. But I think by the fourth quarter, we're going to be off to the races. I'm saying this before, I was saying this before anybody else. I mean, seriously, go ahead. Try to find somebody that was saying this before I was. I don't think you're going to find it. The US economy appeared to be on solid footing just a week and a half ago. But that has changed as several indicators are now raising red flags. So a good analyst doesn't wait for the numbers. A good analyst looks at the reality that's out there and says, this is how it's going to impact those numbers. And that's how it's going to impact the eventual numbers. Anyway, you can't cut 2, 3, 400,000 federal jobs and cut a whole bunch more contractors and cut a whole bunch more procurement and cut a whole bunch of fraud and not have it impact the overall GDP. It just has to, and there's a trickle-down effect. Anyway, the latest and perhaps the most stunning one came on Friday when the Atlanta Fed's GDP cracked. We already talked about, he's repeating himself. That also marks a sharp reversal from we just said that too. The U.S. appeared to, okay, the Atlanta Fed attributed the sudden change to fresh data on U.S. trade deficit, which drags on growth and a weaker consumer spending. Again, started talking about this when I think it was the first week of February when the NFIB, the National Federation of Independent Business report came out. And I said, gee, the small business people are looking a little nervous. The small business people are a little worried about the tariffs and such. And then we had the sentiment indexes coming out. And I mentioned the sentiment indexes. And I said, the consumer is getting a little nervous. Yeah, so this is way before, well, anyway, okay. On Friday, the trade balance in goods showed a record 153 billion deficit in January as imports soared by 34.6 billion versus a 3.3 billion uptick in exports. So people trying to get ahead of the tariff stuff. Now, that's a good idea. I know I've done it in the past to try to build up a little inventory, but the reality is you should start the right way to do this. If you're in business and you don't know this, I'm just going to tell you, if you have inventory in your warehouse that you bought because you got it at a discount, you should still sell every dollar of that inventory, if possible, at the new higher price. This is a big rule. You need to know that rule. If you can get the price, you need to get it immediately. And if you can't get the price, and if you immediately start seeing that you cannot get the price because the consumers reject it, because your buyer at the wholesale level or the retail level, the buyer says no, or you put it out on the shelf and the consumer stop buying it, well, then you've got to be able to react quickly to the reality that it's not gonna sell anymore at that price. You can lower it, you can put it on discount, you can do things to move it through, but the truth is, it may not sell at the new higher price, and you have to decide, can I live with these margins? You might have to go back to your supplier, the exporter, the manufacturer in some other country, and say, hey, it's not going to sell at this price. What are you going to do? Do you still want to be in business? Do you still want to sell to me? If you want to sell to me, it's going to have to be, you're going to have to knock the price down because I can't do it at these margins. Or you're buying it from China. See how maybe Vietnam's making it. Maybe another country, Cambodia, Malaysia, maybe the Philippines. Maybe somebody's got a better price. All right. Anyway, it says, well, most of President Donald Trump's tariffs have not gone into effect yet. Consumers and businesses have been loading up on imported goods since the election to get ahead of the higher prices. The latest report on the durable goods orders, which saw an increase, may also reflect a rush to buy imports early. By the way, the durable goods, we did see that one piece of information that suggested that durable goods were doing better. No, it was all aircrafts. Okay. It was all Boeing. Autos were down, the rest of durable goods flat. Despite the shopping spree on imports, overall demand is weaker. Separate data on Friday showed Americans slashing their spending in January at the fastest pace in 4 years. Unseasonably cold weather was likely a factor, but Trump's policies, including plans to drastically cut federal spending and downsize the workforce also had their fingerprints on it. 100% agree on everything that was said in that paragraph. Increased uncertainty surrounding trade, fiscal, and regulatory policy is casting a shadow over the outlook, according to Lydia Bussour, a senior economist at accounting and consulting firm EY. She told that to the Associated Press. Other data have also sounded alarms on the economy. Jobless claims were up last week. That's a 1-week deal. And it says, because Doge was rippling through the labor market, I don't think so yet. Just don't think so. But it could be people that are anticipating lower sales, not hiring or laying off already. But we're also seeing layoffs happening in tech. Typically, first quarter is when tech lays people off. And we're seeing a lot of large layoffs, 1,000, 2,000 from various companies. In addition, surveys from regional Fed banks found deterioration in the economic outlook, as well as the plans for capital spending. To be sure, 1 quarter of contraction would not constitute a recession. He then goes on to explain what a recession is. I think you know. Economists at JP Morgan lowered their first quarter growth outlook to 1.5 from 2.25, adding that weak January activity should be followed by a rebound in February and March. Yeah, there probably will be a rebound in February and March when these numbers start coming in, but it's not going to be enough, right? And I think, again, we'll really start seeing it. We'll start seeing the impact of Doge more in April, May, June. From now on, we're not inclined to hit the panic button, they said, even though the labor market is showing, again, 1 week of problems. Now, we'll see this Friday about that. Apollo Management Chief Economist Torsten Slok said in a note Saturday that the U.S. economy will suffer a modest stagflationary shock, but won't slip into a recession. You cannot have stagflation at 2.5 inflation. In other words, Doge and tariffs combined with a mild temporary shock to the economy that will put modest upward pressure on inflation and modest downward pressure on GDP, he wrote. There will be no modest upward pressure on inflation. Rather, inflation is caused by too much money, and the bond market is responding appropriately. And we'll talk about but let me just say, encapsulating that, because now we're going to talk about housing, which is 10% of the market, 10% of the overall market is housing. Another 10% is the things that are associated with housing. All the elements associated with housing. And so we'll talk about that in a second. But I just want to say, as much as I'm warning and have been warning now for about a month that we could be looking at a recession, or we could be looking at negative GDP in the second, third, and maybe even the fourth quarter. I don't think so. But what is the flip side of that? Larry Goldberg pointed it out perfectly. Do the interest rates come down fast enough? Okay, and they're coming down fast. Okay, we've already come down from over 4 point, I think we were 4.8 for a day or two. We're already down to 4.2. Okay, and that is fast in 5 weeks or whatever. So if we keep going down, if we can get into the 3-handle, and by the way, Brian Wang and I are going to do a very deep dive at 7:45. Brian is going to bring a lot of the stock market aspects to it, and how he sees the overall stock market and Tesla being impacted over the next many months by all of this. All right, so here let's look at housing. So anyway, if the interest rates come down fast enough, it'll stimulate the economy, and we might not have that recession. We might manage to stay top line, maybe even grow by the third quarter if the interest rates come down fast enough. All right, Market Watch. All right, so now I'm going to give you a little preface to this. As I go through what's going to be said here by Market Watch about housing, please keep in mind we had a super cold winter. That does get mentioned in the analysis. This is the off season for home sales. November, even October, November, December, January, February, lousy for home sales. March is when the market picks up. Okay, and it doesn't get mentioned at all in this article. And then you also have the consumer wariness right now. There's just a wariness. People are probably less likely to be going out and making a big purchase when there's a lot of uncertainty about which direction mortgage rates are going to head. probably down. So why wouldn't you wait a little while? Which way is my job going to go? Do I work for the government? That could be a problem. So there's a lot of wariness out there right now. And so people are cautious. And this is probably also impacting, and that's not mentioned in the article either. So now let's talk about what the article says. Home builder stocks are in a bear market. Yeah, well, duh. As lower mortgage rates and continued rate discounts haven't improved demand. The housing market is changing and become a buyer's market. They think, I don't think, there's just not enough homes, not enough housing. There's not enough inventory. There's more inventory than usual, but no, I'm sorry. There's more inventory than there has been commonly over the last 10 years. The last 10 years has been historically crazy low inventory. Sellers haven't quite accepted that yet. No, and they probably won't because they can hang on. And there's a lot of cash buyers out there. Real estate agents will often argue that the reason home prices are so high is because there isn't enough supply to meet demand. But if you ask a home builder, they say the opposite, that they have too much new inventory. And the tricks that they've been using to entice reluctant buyers are no longer working. I just gave you information, I want to say 2 weeks ago, from the Real Estate Association saying absolutely the opposite of that. They were saying that the discounts that they're giving are the same as they were last year, that the amount of rate buy downs that they're doing is exactly the same as it was last year, and that the amount of time that they're holding on to inventory is about the same as it was last year. Now, did things change in 2 weeks? No, you just have somebody else giving an opinion. Chief Executive Paul Romanowski of D.R. Horton said that the S&P's SPX largest home builder by market, they are the S&P's largest home builder by market cap, effectively explained the dichotomy. He said during the company's recent earnings call, according to an AlphaSense transcript, that while inventories for both new and existing homes has increased, the supply of homes at affordable price points is generally still limited. Yeah, but it's not just the amount of supply of them at the right price. It's also the right product in the right neighborhood. You know, what do you, and it goes on a little bit to talk about that. Basically, sellers have to make the homes more affordable to sell them. And since mortgage rate discounts aren't fueling the same demand they used to, I think that's wrong. Some builders have already turned to their last resort to move unsold homes, which is lowering prices. Wall Street appears to have recognized the problem as the boom in home building stocks is fading fast. Well, the number of homes being built is fading fast. They're dropping the number of, they're not going to build as many homes. Well, now the interest rates have come down over, 50 basis points. That would be a signal, probably time to go out and build some homes. The share of U.S. home construction's ETF has fallen to around 7-month lows and is trading about 24% below the record close reached in mid-October, when many on Wall Street would say puts the ETF in a bear market. Well, going into October, interest rates had been falling, but then they started going back up again. I'm talking about the 10-year. Okay, nothing else matters. But the 10-year has been going up steadily. It's gone up 100 basis points from the low of about 3.75 to the high of almost 4.8 during the Biden administration. Because why? Because inflation was kicking back in. And even as the Fed was lowering rates, they lowered rates by 100 basis points. And instead of going down, the 10-year went up 100 basis points. This is extremely unusual, but I'm going to say it was because the Biden economic approach was horrible. After looking at the 3-year logarithmic chart, which are often used by chart watchers to better relate changes in price over long periods of time, the ETF broke a 2-year uptrend line in mid-December. That breakdown was confirmed when a subsequent attempt to reestablish the trend failed. The decline in home building stocks is the tip-off that trouble is brewing in the housing market. Sometimes it's the fact that the change has been happening so fast in those 10-year mortgage rates that the stock is chasing around the mortgage rates. That's what I'd say is happening. A big reason for the decline, and the mortgage rates have only been coming down for 5 or 6 weeks. A big reason for the decline is the recent weak industry data, including a big drop in sales of newly built homes, falling home builder confidence, and pending home sales. Deals under contract, but which are not yet closed. All of those are at record lows. So what's worrying the builders is that this weak data is coming even as the rate on 30-year mortgages has fallen for the sixth week in a row to 6.76. It is now at 3.61. I just saw it a few minutes ago, and it'll probably be lower on Monday. Even with the lower rates, real estate services company Redfin Corporation said that based on current selling rates, there was a 5 months of housing supply on the market during the 4 weeks ending February 16th, which is the most in 5 years and up from a 4.1 months a year ago. The last 2 years, especially last year, the winter sales were stronger than usual. Why? Oh, because rates were low. They were under 4. They were at 3.75. Remember that? Wow. Okay. A typical home sold took 57 days to go under contract, the longest since the start of the COVID pandemic. Basically, sellers are still asking too much for their homes. I don't think they're going to find that's true. Give it another 60 days or less, maybe even 30 days. Sellers are acting like it's a seller's market, but it's not, according to Redfin. And hey, Redfin should know, but I think they're wrong. It's getting closer. Okay. All right. Now, you see, you got to watch the words. He says it's getting closer to being a buyer's market. He's saying all this at the end of February. Why isn't he saying, but, the market picks up in March. Home builder stocks are in a bear market as lower mortgage rates and continued rate discounts have an improved demand. The housing market is changing. What? I just doubled all that. Look at that. Wasn't that clever of me? All right, so that was actually the end of the story. I hope that was valuable to you. What we're looking, I believe 100%, I'm just going to tell you, this is how I see it. I think we're going to have a flat economy. In the first quarter, will probably be up, maybe 2, maybe 1 3/4, maybe 2 1/4. It's, there's so many things that can happen. Like, for instance, the import-export thing, that has an impact on the GDP, and it's not an impact on the GDP that helps you understand what's really happening at the street level. So the first quarter is going to be, who knows? Second quarter, flat to down. When I say flat, it might be up 0.5%, the GDP. But now, maybe by the third quarter, we're already seeing the increase in housing sales, increase in car sales, increasing on number of homes being built, increase of permit pending, permits, housing permits. Maybe we're starting to see actual durable goods, refrigerators and bicycles and stuff actually selling through. If we see all that, then the economy will be roaring by the fourth quarter. And I mean roaring by the fourth quarter. So that's how I see it. All right. Now, what does that have to do with the stock market? Well, the stock market has already given you a little bit of a hint. Will it go down from here? I don't know. Friday was a nice bounce, but I really feel like there's an opportunity for the stock market to take another 5% off. I don't think it'll go into a bear. I think there's the smart people, the smart ones, the really smart ones, are also recognizing that this is, I hate to use the word, transitory, that what Doge is doing is not the long-term economy. It's the short-term economy, and it's beneficial long-term to the economy. So the smart ones will get that, and they'll be trying to predict when will the economy turn. That's what I'm trying to do. When will the impact actually be felt? So if it's felt a lot faster, if we really get into threes on the interest rates really fast, well, then the economy could boom early, and it would more than make up for the government cuts. Let me know in the comments below where I'm completely off my rocker, or where you think that made sense, or where you'd like to trim it a little bit up or down or sideways, or anything else that you want to say or ask about what I just went over. But you definitely want to follow this one up with my conversation with Brian Wang, because, he's smarter than me. And so we're going to want to listen to what Brian has to say about the timing, what he sees as the timing, how he's a little bit different than me in how he's anticipating what happens the rest of the year. And he and I will talk more about the actual Tesla stock, what happened on Friday, what might happen in the next few weeks, and where are we going, later this year. And you know what I think about later this year. You already know that stuff. All right. And then earlier this morning, we had a CERN Basher video. I'll put the card right up here where CERN and I spent a lot of time talking about the history of Tesla stock. So I'm talking about the future. Brian Wang will really be talking about the future. This morning, CERN was talking about history. And what is history good for? Giving us an inclination, an indication, some kind of an understanding, analysis that will help us learn about the future of the stock. All right. So this is, has always been a great time. I've really enjoyed having this conversation with you.